Hey everyone, and welcome back. Ready to dive into a world where, well, let's just say things move fast.
Faster than the caffeine rush to the stock market, right?
You got it. We're talking day trading, and today's deep dive is all about separating fact from, well, those flashy trading guru promises.
And let me tell you, our source material, Day Trading y Operativa Bursátil para Dummies, doesn't hold back.
No sugarcoating here.
None whatsoever. It's written by Francisca Serrano, a trader who's been in the trenches, and she lays out exactly what it takes to make it in this world.
All right, so no more Lamborghini dreams fueled by those get-rich-quick seminars.
Not in this deep dive.
Yeah.
Francisca actually shares this story, I think it was chapter 3, about how she almost lost everything because she thought she had a sure thing.
Ouch. Okay, so lesson one, it's not as easy as it looks.
You can say that again. And that emotional pressure, that pops up everywhere in her book.
So how do you, prepare for that? I mean, trading all day sounds intense.
Francisco really emphasizes discipline and understanding your own psychology, just as much as charts and graphs.
It's like you need nerves of steel.
She even compares it to learning to drive. You wouldn't hop in a car, especially not some fancy sports car, without lessons and a license.
Right, makes sense. So trading knowledge is your license.
Exactly. And practice. Well, that's where you learn to handle the road before you're risking it all on the freeway.
And speaking of risks, we can't forget about everyone's favorite topic, taxes.
Ah, yes, good old Hacienda. Your source is very clear. You need to get those financial ducks in a row. Choosing the right broker, understanding their fees, it's all critical.
So finding a broker is more like picking a partner for this wild ride.
Absolutely. You need someone you can trust, someone who aligns with your goals and risk tolerance.
Okay, so we've got our trading license, a trusty co-pilot by our side. But what about the actual tools of the trade? Do I need a NASA control center to day trade?
Well, maybe not NASA level, but reliable tech is key.
So what are we talking about here? Multiple monitors, lightning-fast internet?
You got it. Your source breaks down essential hardware and software, and that internet speed. Crucial. Milliseconds matter in trading.
Right, because a lag could mean missing out on a big opportunity.
Exactly. Any delay can be the difference between a profit and, well, not so much.
It's all about timing. And speaking of timing, your source mentions some legendary traders, folks like Larry Williams, the guy who turned $10,000 into $1 million in a year.
Ah, classic example. And even he stressed the importance of knowing when not to trade.
Really? Even with all that success, he believed in the power of no.
Absolutely. Sometimes the best move is to step back, assess the situation, and live to trade another day.
Okay, so it's not just about being a gunslinger in the market. There's a strategy to it. But how can a newcomer compete with the Wall Street pros, those guys with algorithms and, well, a lot more money?
Here's the thing. The markets are more accessible than ever.
Yeah.
And your source emphasizes that anyone can find their edge. It's about knowledge, strategy, and that emotional discipline we talked about.
So finding your own rhythm in the chaos.
Exactly. And that's what we'll explore as we dive deeper into your source material.
All right, so we've talked about the mental game of day trading, but what about the actual mechanics? Where do we even begin to decode all those charts, indicators, and frankly, intimidating jargon?
Well, thankfully, your source breaks it down in a way that even I can understand. And trust me, I've seen some pretty dense financial reports.
So where do we start?
Let's start with something that sounds a bit intimidating, but is actually pretty simple. Volatility.
Okay, volatility. I've heard that term thrown around. What's it mean in the trading world?
Imagine a lake on a calm day, barely a ripple. Then picture a raging ocean during a storm.
Okay, I got the visual.
That calm lake.
Right.
That's a stable market, not much price movement. Volatility. That's the storm, rolling in waves, crashing, prices all over the place.
So more volatility, more risk, but also maybe more chances to make money quickly.
Exactly. Higher risk, higher potential reward. And here's where it gets really interesting. Your source talks about leverage. It's like a megaphone for your money, amplifying your gains or your losses.
So leverage is a tool to use carefully.
Absolutely. Too much leverage in a bad trade. That could really hurt.
Makes sense. Now let's say I want to dip my toes into trading, but I'm not ready to go all in.
That's where derivatives come in. Imagine you see this delicious cake at a bakery, and you might want to buy it later. A derivative is like putting a small deposit down to lock in today's price without buying the whole thing right now.
So you're protecting yourself from, a sudden cake price increase.
Exactly. Your source breaks down different types of derivatives like futures and options. Think of futures as committing to buying that cake next week. Options are more like, I'm reserving the right to buy it, but I might change my mind.
Options sound tastier, especially if you're not sure. But how do you actually find those buy or sell opportunities in the market?
That's where chart analysis comes in.
Charts, those graphs with the lines that always seem so complicated.
They can seem that way, but think of charts as a map of the market's past. They can help you spot trends and potential trading opportunities.
Like a treasure map, but for traders. So what kind of clues are we looking for?
One of the most popular types, candlestick charts. They're actually pretty cool, visually.
Candlestickcharts.go on.
Each candle on the chart shows you the opening, closing, high, and low prices for a specific time period.
So you can see how the market, or maybe the traders, were feeling that day.
Exactly. And by analyzing these candlesticks, you can start to notice patterns, formations with names like the hammer or the engulfing pattern.
Wait, so certain patterns have names?
Yeah, they can give you an idea of whether buyers or sellers are in control.
It's like learning a whole new language. But you're not just looking at individual candles, right? What about the bigger picture?
You're right. We also have something called trend lines. Imagine guardrails on a highway. They guide the general direction, right? Trend lines are similar, showing you if a price is generally moving up, down, or sideways.
Okay, makes sense. But things change quickly in trading. How do you know when a trend is about to reverse?
Well, your source talks about support and resistance levels. Support is like a floor. Buyers tend to step in when the price drops to that level. Resistance is like a ceiling. Sellers often take over when the price hits that point.
So it's a constant battle between buyers and sellers, pushing the price up and down.
You got it. And by understanding these dynamics, these levels, you can try to anticipate those big turning points.
This is fascinating. But how do you know when a turning point is actually happening, not just a blip on the radar?
Great question. That's where those indicators come in handy.
Indicators. Give me some examples.
Sure. One common one is the moving average. It helps smooth out those price fluctuations and reveal the underlying trend. Then there's the relative strength index, or RSI. It helps you see if an asset is overbought or oversold, like when a stock price has gotten way ahead of itself.
So it's about confirming what your gut's telling you, right? Getting that extra layer of reassurance.
Exactly. And there's one more key factor that often gets overlooked: volume.
Volume. Like how loud the trading floor is.
Not exactly. Volume tells you how many shares are being traded. It gives you a sense of the conviction behind a price move. Think of it like this. If you see a huge crowd rushing into a store, they're probably there for a massive sale, right? High volume means serious interest.
So high volume could mean a strong trend, while low volume might signal some weakness or uncertainty.
You got it. It's another piece of the puzzle, helping you gauge the strength of a move.
Okay, we've covered volatility, leverage, derivatives, charts, candlesticks, trend lines, indicators, and volume. Phew, I need a coffee break.
It's a lot to digest, I know. And we're just scratching the surface. But your source does a fantastic job of making these concepts clear.
It really does. But even with all the knowledge in the world, trading involves real money, real risks. What about that aspect?
You're absolutely right. And that's where risk management comes in. Your source actually devotes a whole section to it.
Right. Traders and aspiring traders, get ready because things are about to get interesting. We're talking advanced trading strategies today, the kind that can really level up your game.
But just like our source material emphasizes, this isn't about jumping into the deep end without knowing how to swim.
Right. Got to master those basics first. So what's first on our list of advanced tactics?
Well, your source starts with breakout trading. Imagine a coiled spring suddenly released. That's a breakout.
Okay, I can picture that. But how does it apply to trading?
You're looking for those moments when the market bursts through a key support or resistance level, often leading to a significant price move.
So you're trying to ride that wave of momentum.
Exactly. Francisca even outlines techniques for identifying these potential breakouts, like analyzing chart patterns and monitoring trading volume for those telltale signs.
Like predicting mini earthquakes in the market.
That's a good way to put it. Now, on the flip side, we have mean reversion trading. Think of it like a pendulum swinging back and forth.
Okay, I'm picturing it.
Prices might fluctuate in the short term, but they often swing back to their average or mean over time.
So with mean reversion, you're looking for those extreme swings and then betting on a return to normalcy.
Precisely. And there are indicators like Bollinger Bands that can help you spot these potential turning points.
This is really cool. What other techniques does Francisca share?
Well, this next one might be more familiar: arbitrage. Imagine finding a rare book at a bargain price, knowing you can sell it for much more online.
You're profiting from the price difference.
Exactly. In trading, it involves finding similar price discrepancies between markets or exchanges and exploiting those inefficiencies.
Sounds like it requires speed and precision.
It does. Those opportunities can disappear quickly.
Okay, noted. Now, what about this algorithmic trading I keep hearing about? It sounds pretty high tech.
It can sound intimidating, but it's basically using computer programs to execute trades based on preset rules.
So you're setting up commands like, if this happens, buy, but if that happens, sell.
That's a simplified way to think about it. Your source points out that it can help remove some of the emotion from trading, especially for those split-second decisions.
So a little less gut feeling, a little more calculated strategy. Makes sense. Anything else on the algorithmic trading front?
Francisca does emphasize that you need a good understanding of both programming and trading strategies to really make those algorithms work for you.
Noted. I'll stick to my charts and indicators for now. What else is on our list of advanced moves?
Let's talk about hedging. Imagine you're at the horse races, and you really like a certain horse, but you place a smaller bet on another, just in case.
You're protecting yourself if your main pick doesn't win.
Exactly. That second bet is your hedge, a way to manage potential losses.
So it's like buying insurance for your trades.
That's one way to look at it.
Smart. Okay, hedging. I'm adding that to my list to research further. What's next?
Last but not least, we have spread trading. This one's a bit unique. Imagine two runners in a race. With spread trading, you're not betting on who wins, but on the difference in their finishing times.
So you could profit even if your initial pick doesn't come in first.
Precisely. It involves buying and selling two related assets, looking for the price difference between them to either widen or narrow.
Okay, definitely a more advanced technique, but it sounds like it could offer some intriguing opportunities.
It does. Your source provides some good examples to illustrate how it works in different market scenarios.
We've covered so much ground in this deep dive, from the fundamentals all the way to these seriously cool strategies. It's clear that day trading is more than just, well, watching numbers on a screen.
It definitely is. And as Francisca highlights, it's a journey of continuous learning. The markets are always changing, so to succeed, you need to be adaptable and always seeking new knowledge.
So find a few strategies that click with your style and risk tolerance and never stop learning.
You got it. And remember, day trading is a marathon, not a sprint. Discipline, resilience, and yes, even a bit of patience, those are key.
That's some great advice. It's been incredible exploring the world of day trading with you all. And remember, whether you're a seasoned pro or just starting out, never stop learning, exploring, and as always, happy trading.